Thanks, Mark. We've heard from value managers today, we've heard from growth managers, we've heard from investment styles that focus on income. Longwave are a quality-focused investment manager. But by far, the largest investment style in small caps 2 years ago was magical thinking. Magical thinking was the thing that saw a record number of loss-making companies traded over $100 million in market cap in Australia. Investors saw interest rates go to zero and they lost their minds. So Warren Buffett said earlier about more people doing dumb things. We saw a record number of people doing dumb things in Australian small caps in the last 2 years. And that's slowly starting to unwind. So interest rates are going back up again. We've heard about that today. And we're seeing the number of these speculative companies rapidly decline as people come to their senses and think about the businesses they're buying and what they're paying for them. So the way we protect ourselves and protected ourselves through this period is focusing on quality businesses. We focus on companies that generate strong ROEs and real cash flows. And so we think that era of magical thinking is over, and we have to get back to looking at real companies and understanding what they're worth. The other thing that we're seeing at the moment in the small cap market is the impact of higher interest rates flowing through into company earnings. Everyone was focused for the last few years on the mortgage cliff, so fixed to variable roll-offs and a reset to higher interest rates. People forgot that most companies also borrow on a fixed term. So this chart to the left, this Australian investment grade corporate debt chart, is a 3-year tenor of what the average investment grade corporate borrows at. And so for the last couple of years, even as interest rates have been going up, we haven't really seen the impact through the P&L of the companies across the market. And this chart to the right is the index. So it's the aggregation of all the companies in the Small Ords and their interest expense bill. And in the last year, we've seen a 33% jump, or $1 billion more of interest expense going through the P&L, which comes straight out of the shareholders' pockets in terms of what's left to EPS. And this was a surprise to markets. About half of the downgrades we saw in reporting season came from these higher interest expenses, and that's likely to continue for the next couple of years. So the second thing we can do to try and protect our portfolios against this change is to ensure that when we're looking at the investment in companies, looking at investing in companies in small caps, we focus on the balance sheets. We understand how much debt they have, their ability to service debt, and how much of our profits or profit growth is going to go to bondholders or the banks versus us as equity holders. Now that's a pretty bearish backdrop to start with, but we're not bearish at all, because the opportunity in front of us for real businesses and real investment is actually pretty exciting. Let's look at the big picture. So Australia has the 3 things that any country needs for sustained long-term growth. We have capital, we have a huge superannuation system in Australia, we have incredible natural resources that we all sometimes forget about in terms of underpinning the growth in this country, and we have population demographics that are the envy of the developed world. The chart to the left is showing you the past 10 years. The chart to the right is showing you out to 2050, so sort of global forecasts for population growth and the age of our population. So we're going to stay younger and grow faster than almost every other developed country. You have to go into emerging markets and the risk that that entails in order to find demographics as compelling as Australia. Now, we're not top-down investors. This is interesting for us because it sets the scene that we should stay positive in looking for opportunities. But inside small caps, you really need to look at what the actual companies are doing and not take macro or sector views. I mean, it was only, 6 or 9 months ago that economists said there's a 100% probability of a recession, which we've yet to see. And of course, all of those forecasts are being watered down. It's quite remarkable to make a forecast with that much confidence and yet not be correct. So what do we mean by focusing on companies and not macro? Well, we've got some examples here of earnings forecasts for a range of small caps clustered into the sort of sectors and markets that are similar in which they operate. And what we're looking at here are the earnings expectations that consensus had, that the market had for these businesses at the end of December last year, and where we've got to at the end of reporting season. And so within the same sectors, you're seeing very large divergences in the earnings outcomes for these businesses. Now, retail's been tough. There's more sort of down than up, but there are a couple of retailers who have executed very well, who are earning more today than the market thought they would coming into 2023. Tourism and leisure we'll talk a bit more about later on. that's been a very strong sector. And in fact, Star Entertainment down there at the bottom, it's really a company-specific issue that we're probably all aware of that has caused their grief. It's not to do with what's happening inside that market. A few more we'll look at. Small financials, again, big divergence between the winners and losers. The magnitude of difference on only a 9 months or 8 months period of time is quite surprising. But that's not unusual in small caps. We see it all the time. And so taking a sector view, while we want to be defensive, let's own healthcare stocks, isn't enough. You need to know which healthcare stocks you're going to own and actually which stocks in what could be seen as cyclical sectors, like the industrials over there on the right, are doing much better because management are executing. They're pushing through price increases. They're expanding margins into a tough environment. So it's always, we believe, incumbent on us as investors to focus on the businesses we own and the opportunities that are in front of them and not get too caught up in the macro forecasting of what may or may not happen across the broad economy. Now, Boral and Fletcher Building are an interesting case there because they're both in the same sector. They both dealt with price increases through this year very differently, and Boral executed far better in putting through price increases, holding on to their margins, where Fletcher Building sort of mishandled that process and saw their margins go backwards relative to where the market started the year. So management execution in a very short space of time made a huge difference to how much these companies are going to earn. We'll look at a building materials company in a moment that really steps back and says what matters is the long term. So these are short-term periods. It's really just to illustrate the divergence we can see. But as investors, we are investing on at least a 3 to 5 year time horizon. And so what happens structurally and in the long term does actually matter more to us. So let's look at a couple of examples of stocks where we are seeing opportunities today in small caps. The first is Nanosonics. Nanosonics are an Australian medical device company that specialise in disinfection of hospital devices. So their Trophon device is their sort of flagship product, and that's involved in disinfecting ultrasound probes in the hospital setting. It's a classic razor and razor blade business model, and we've seen this in medical devices in Australia before. So Cochlear has a business that sells implants and it also sells the processors. ResMed and Fisher & Paykel have businesses that sell CPAP devices but get recurring revenue from selling masks and tubing and other parts to the product. And Nanosonics is no different. They sell the machine to the hospital, but every year they're selling consumables into that installed device. And so over time they've had this very rapidly growing revenue base, but it's product and services, or consumables in this case, that is recurring. It's a very high quality business. It's grown revenues at 27% per annum for the past decade. But of course, revenue growth is not the only story in terms of finding a good investment. We need to think about price. Now, I'll start by showing you an EV to sales number. We will get to earnings, but it gives you some context as to how the market has priced this stock over the past 10 years and how this derating of all stocks in small caps, Mark has touched on it before, and we'll show you another slide in a moment that gives you some context to that, has presented these opportunities to us in the repricing of high quality businesses. And so in the case of Nanosonics, we've seen an EV to sales multiple that approached 20 times, now down closer to 5 times. Is that good value? Well, for the first time ever, at this result, Nanosonics disclosed the divisional profit of their Trophon product. So Nanosonics is Trophon as their producing business and an R&D pipeline for new products that they're investing through the P&L, which can muddy the profitability of the business. What we're seeing here is just the profitability of this Trophon business, and we can see that in 2 years' time, that business should earn about $70 million of EBIT. The company have said it's likely to earn $50 million next year. And on that basis, we're paying 16 times EBIT for Nanosonics, against 31 times for Cochlear and 27 times for Fisher & Paykel. So high quality business, change in market sentiment, and a valuation opportunity relative to other large caps or relative to large caps that's quite compelling. So the second example is CSR. Now CSR are a business that everyone knows, but often the history of knowledge can weigh us down with what a company used to be. So CSR, along with Boral, Fletcher Building, Adbri, Brickworks, for many years, James Hardie, for many years they operated in intensely competitive, undifferentiated market segments. And so what resulted from that was low and volatile returns. They just weren't great businesses. They had competition internally, they had competition from imports. Over the past 2 decades, CSR have divested out of sugar, out of bulk concrete, out of glass. They have a small position in aluminium, but they've focused their business in building product categories where they're either number 1 or number 2 in highly consolidated markets with very little competition. What does that result in? That results in an increase, a dramatic increase in the return on capital in this focused business that they're left with. Now, CSR often sits with another group of stocks we look at in the market that are in a blind spot for many investors. It's too small for a lot of large cap investors, and it's not exciting enough for a lot of small cap investors who are trying to find the next lithium stock or the next Afterpay. So CSR is a really interesting opportunity for us, where we believe it's a high quality business trading at less than 10 times earnings, and often in a market that's overlooked in our part of the universe. The last example I'll give is travel. I touched on this briefly earlier, but really what we're looking at here is the recovery back to pre-COVID levels. Lots of industries are now, like COVID's behind us. All the pre-COVID, all the sort of COVID disruptions are finished. Travel is still recovering back, and the expectation is that we're not going to get back to pre-COVID earnings until 2025. There's a chart from Qantas looking at capacity on the left, and the chart on the right is really looking at 5 small cap travel stocks and where the market thinks, so again we're using consensus estimates here, where the market thinks their earnings will be in 2025 relative to 2019. And many of these companies have expanded their businesses, they've taken advantage of the disruptions to gain market share, and will earn significantly more in 2025 than they did in 2019. But other than Flight Centre, almost all of them have much smaller increases in their market value relative to that 2019 base. So there's still, in our view, lots of opportunity in the small cap travel stocks. Mark has showed you a chart that looked at the underperformance of smaller microcap versus the 100. This is a similar chart, but the additional context it gives you is how far we are through this versus other similar drawdown cycles. And so the only point we would make here is that relative to the tech wreck and the GFC, we're further along. We've been underperforming for longer, and we've underperformed by just as much. Now, we don't know when things will change, but we do think we're further towards the end of this than the beginning. And so we think that in combination with the opportunities we see at the stock level, this underperformance is providing an opportunity to allocate back into small caps. And as I say, if history is any guide, it looks like a pretty good time. Mark mentioned up front that we have a different view of diversification. We actually think there are a lot of myths in small caps that people believe, and one of them is if you're too diversified, you can't perform. We've been running a highly diversified small cap strategy for over 7 years, and we're very proud of the performance that we've delivered for our clients over that time. So the bottom line for us in small caps, we think that the underperformance is likely behind us. We think the best place to stay in small caps is in good businesses with good valuations, and we think investors should always avoid magical thinking. Thank you.